Our first speaker today is Professor Warwick McKibbin. Warwick is the Director, Centre for Applied Macroeconomic Analysis at the Australian National University. It's in the ANU College of Business and Economics, and he's also Adjunct Professor in the Australian Centre for Economic Research in Health at the ANU. Also, he is a Professorial Fellow at the Lowy Institute for International Policy in Sydney, a non-resident Senior Fellow at the Brookings Institution in Washington, DC, where he is co-director of the Climate and Energy Economic Project. He is President of Mckibben Software Group, and he is a member of the Board of the Reserve Bank of Australia. He recently served as a member of the Australian Prime Minister's Science, Engineering and Innovation Council and on the Australian Prime Minister's Task Force on Uranium Mining, Processing and Nuclear Energy in Australia. Would you please welcome Warwick McKibbin?
Thank you very much, Geoffrey, and thank you also to the Whitlam Institute and the University of Western Sydney for asking me to present today. My role was to set the scene, so you could call this presentation Life, the Universe and Everything. And the answer actually isn't 42. The answer is 42 plus or minus 20. And you'll understand the meaning of that towards the end. What I wanted to do in talking about what are the challenges facing Australia is actually start looking at what the challenges are facing the world, because it's a big mistake for policymakers in small open economies to think that their focus is actually what's happening in their economy. What happens in the world really matters for what happens in Australia. There are wide ranges of challenges in the short term, in the medium term and in the long term. I will then burrow down and look at a couple of key challenges facing Australia. One of those is dealing with climate change, and another is how to deal with the massive shock coming towards us from an emergence of China and India into the global economy. Now, all of these shocks and all of the projections of the future I'll be talking about all involve, from an economist's point of view, substantial changes in relative prices. And the theme of how do you deal with policy responses when relative prices are changing in very, very large magnitudes is really the theme going through this presentation. To give you an example, the price of energy and resources is likely to be sharply rising while the price of manufacturing is falling. The price of money is likely to be changing dramatically over future years in different countries. The price of high-skilled labour versus low-skilled labour is likely to be changing substantially. There's a whole range of relative prices that policymakers need to deal with. Now, if you fall asleep from this point on, I just want to give you the punchline. And the punchline is that when you're designing policy, we should not think that the world is a deterministic place and that we know what the future will be when the future arrives. Policy has to be designed to deal with enormous uncertainty. Just look back the last decade and look from a decade ago what we imagined the world would look like today, and I can guarantee you would have pretty much got it wrong. So what's clear here is that policy has to be incredibly flexible, has to be well designed, institutions have to be designed to deal with the uncertainty, and there's several other key issues in policy design that I think we just haven't got right. So some fundamental questions that you have to think about over the next decades. Firstly, what is the role of the private sector versus the public sector? Do we prefer market failure or government failure? How do we create the incentives to guide individual actions, or do we just settle for command and control where the state knows better than the individual? When we regulate, do we have no regulation? Do we have bad regulation? Do we have optimal regulation? At the global institutional level, there's a big issue about do we want to have a centralised global government or do we want to coordinate national systems? Now, there are debates to be had across all of these philosophical issues, but these are the issues I think the globe is facing over coming years. And very importantly, and we've learnt this in the Australian context, we've learnt this in the international context, is that the institutions we build are incredibly important for a variety of reasons, but one of the key ones is to get rid of this populist economic short-termism that goes on in many economies. And so we have to be very careful. We've built the Productivity Commission, we've built the Reserve Bank, independent institutions. We need to do the same thing in the climate area and several other areas. What are the global challenges? And I'm not obviously going to talk about every single one, but I think it's worth laying out the main ones. Firstly, we have the North Atlantic financial crisis. And we have to worry about how do we recover from a crisis which is very asymmetric. The industrial countries, particularly North America and the UK, are in a very different state of the world than everybody else. How do we deal with global macroeconomic imbalances? Are they gone? They're a key part of the financial crisis. My view is that they're certainly not disappearing. Do we have to deal with these or not? How do we deal with what you could call the elephant in the room, which is probably a bad pun? But how do you deal with the elephant in the room, which is the emergence of China and India? We know this is important because we could see what was happening in the last 10 years to the relative price of energy and scarce resources relative to manufacturing. We know it's important because some people argue that the accumulation of trillions of dollars of foreign exchange reserves in China was one of the reasons why we ended up with the financial crisis that we saw in North America. So that's a very critical issue. Underlying this, over many decades ahead, there is a massive global demographic transition coming our way. Very different in very different in different regions of the world. China is very, very different than India, and I'll talk briefly about that. How do we deal with climate change, and how do we deal with the world's need for energy over coming decades? How do we deal with the economics, or how do we deal with infectious diseases? H1N1 is still very much in the news, still very high probability of a mutation in the North American winter. We have to have mechanisms in place. We have to invest in prevention in the poorest of poor countries to prevent this from being a major economic problem. How do we deal with managing water resources globally? How do we deal with governments reform, the international institutions, the financial architecture, the world trading system, foreign investment guidelines, the global environment? So that's a very small list of big issues, and I imagine each one of these questions, although it's a global question, there's an Australian analogue that goes with it, and the other speakers this afternoon will no doubt touch on this. What I want to do now is just pick off pieces, and actually I do usually have a view on things, and I want to pick off the pieces that I have a strong view of, lay out my view, and hopefully some other speakers will address that, or people from the audience later on. There are some big problems in the recovery, and we are in a recovery phase of the financial crisis. There are issues related to the monetary policy stance of the world. I should also mention that my remarks, I should have said this at the beginning, my remarks are personal and don't reflect the views of the Reserve Bank of Australia. We have to deal with fiscal policies in various countries, and we have to deal with trade policies. Now, at the moment, we're backing away from a Doha round, and countries are moving towards protectionist policies. We have to think about what that means. So what's the stance of global monetary policy? This is a very big problem because we have basically zero interest rates in major economies. This is a very distortionary policy. It's necessary given the macroeconomic situation that these countries face, but it's a situation that has to be unwound very, very quickly. Both for these economies, but also because many economies in the world are pegging to the US dollar. So the monetary policy in these countries, big developing countries, are the US monetary policy. So we have really a surge of growth in the developing countries, not affected badly by the financial crisis, these economies adopting the policies of a crisis economy. That is a recipe for a big problem down the road. In my view, there already is a global bubble in the making, and this has to be addressed very, very quickly by global monetary authorities. Just to give you an idea of just what the situation looks like, this is a picture of the Fed's balance sheet. This shows you the composition of assets as well as the change in assets when the crisis occurred. And the Fed normally has a balance sheet of around $1 trillion. That at the end of 2008, after the Lehman Brothers collapse, the Fed started buying agency securities, Fannie Mae, Freddie Mac, shares, all sorts of commercial paper. They actually started buying the private sector in the US, and you can see that the balance sheet of the Fed expanded dramatically to over $2 trillion. Now, this situation is not sustainable. If this is not reversed, this is future inflation. And the question is, how does the Fed unwind the balance sheet without unnerving markets? This is not just a problem in the US. This shows you what's happening to credit growth in China. In the last quarter, credit growth in China was over 33% annualised. So we have a massive, massive surge of liquidity in China. This is not sustainable. What about fiscal policies? Fiscal policies have really been quite dramatic. Here's some graphs. This is a graph from the latest OECD Economic Outlook that came out last week. You can see that up until 2007, deficits were running around 2 to 4% of GDP. If you look at these graphs, you can see the most amazing change in fiscal policy. In the UK, budget deficits of 13% of GDP. In the US, greater than 10% of GDP. These deficits are big, and they're not projected to go away in the next few years. This is a massive absorption of private sector wealth into government coffers. A 10% of GDP fiscal deficit is a very, very large fiscal deficit, unprecedented since the Second World War in the US. What does it mean for debt? Well, it means that if you look at this chart of projections from the OECD for 2011 versus 2007, government debt in the US will be 100% of GDP. In Japan, 200% of GDP. Now, what does 100% of GDP government debt mean? It means at an interest rate of 5%, you have to take 5% of the economy to pay the debt interest per year. Now, that's an amazingly large amount of revenue transfer that the governments in these economies are distorting their economies. What's happening on the trade front? Well, nothing, except bad news. There's a tendency, as there was in the Great Depression, for countries to turn inward-looking, to protect domestic industries. We're already doing that to protecting domestic financial industries. There's a movement to protect domestic manufacturing industries. What happens if there's a trade war? There's a paper published this week by the World Bank that I co-authored with Andy Stokel, where we looked at what happens if every country in the world increased tariffs just by 10%. And it is possible to raise tariffs by 10% without incurring the wrath of the WTO by various policies within the WTO rules. You probably can't see this chart, but just to give you an idea that the results of that paper show that by 2011, the change in GDP in the first column of every country for a global trade war is devastating. For some countries, let's take China, GDP falls by 4.3%. For Germany, GDP falls by 3.8%. This is not a big trade war, this is a small trade war, but this is how linked the economies of the world are today, that if we start putting up barriers, we can end up with some very significant economic slowdown. What's interesting, and you can't obviously digest all this material, but if you look across each column, it tells you what is the impact on each country on the left by a change in tariffs by the country across the top by itself. And what we find in this framework is that raising tariffs hurts yourself, which is the opposite to the populist view that raising tariffs protects yourself. It hurts yourself, and it also hurts your neighbours. So if everybody does it together, everybody is in big trouble. Now, the reason tariffs hurt you is because in the global system we've developed, there's a lot of trade in capital goods. And if you put a tariff on capital imports, you increase the cost of capital, you reduce investment, you contract your economy. This is something to be avoided in the modern world. Now, before the crisis emerged, there was a lot of discussion of macroeconomic imbalances. And most people focused on one imbalance. There are actually two imbalances in the global economy. One imbalance was that global savings was in excess of global investment. That meant that real interest rates were remarkably low. That meant that corporations and individuals were investing in very, very risky activities in an attempt to generate a bit of yield on their investment. So the first distortion we faced was this large imbalance between savings and investment. Now, that's actually gotten worse during the financial crisis. Global investment has shrunk, global savings has risen, real interest rates around the world are historically low levels. This is a problem in terms of the nature of the recovery and the nature of investments that are being undertaken. The other imbalance, which is the one people are familiar with, were actually the current account imbalances. And these current account imbalances, a lot of people think about in terms of exports and imports, but I find it more useful to think of it in terms of savings versus investments. So those countries that saved more than they invested tended to run current account surpluses, because those savings were going overseas. Those countries that invested more than they saved generally ran current account deficits, and they were pulling in savings from overseas. So these imbalances showed up through current accounts and therefore through trade flows, and that led to a lot of political risk in terms of financing of capital flows, as well as potential for accusations of mercantilist policies. What's the current status of the global imbalances? I don't know how well you can see this chart. It's from the OECD. But if you look, I can't point because I'm standing behind the screen. I can point down here. If you look at that chart, you'll see that below the line are the countries that are running big current account deficits, and the bluish line is the US. And then you see there are several other countries, including Australia, in the rest. These are the countries that are sucking in capital. But if you look above the line, you see China is the dark blue line, and then we have Japan, we have Germany, and then we have oil exporting countries above those. So you can see that there are several regions are the key exporters of capital, several regions are the key importers of capital. You can clearly see where the financial crisis occurred and these imbalances contracted. Now, in a very optimistic set of projections, you can see that the OECD is projecting that these imbalances are going to drift further apart again. And in my own work suggests that this is going to be a much more rapid process. So these imbalances haven't gone away with the financial crisis, and these imbalances are likely to get worse before they get better. One of the reasons for these imbalances, and one of the reasons for the sort of structure of the world economy we see today, is the emergence of China and India. And this is a key set of issues that we as a nation in particular have to deal with. If you look at the scale of these countries, it's useful just to look at population first. And this chart shows you population in 1950, 2005 and 2050, where we're ranking countries in size. So you can see in 1950 China was the biggest country. It had about 5.6 billion people. Sorry, it had half a billion people, and that was 22% of the world population. Now, as we look at 2005, China now in 2005 has 1.3 billion people and is 20% of the world population. But as we move to 2050, there's a major demographic shift going on in China, and India overtakes China, the world's largest population, with 1.6 billion people. By 2050, the UN projects about 9.1 billion people in the world compared to about 6.7 today. So we have this major change going on in China and India. You also notice in 2050 that most of those countries in that column are emerging developing countries. We have Pakistan becoming the fourth most populous country in the world, Indonesia the fifth. There's a lot of economic, political issues associated with big shifts in population. What are the economic impacts of these big changes in the global economy? Well, first there's the scale effect. With these masses of population coming into the world economy, the economy is going to get bigger. There's going to be changes in the composition of production because these are very poor people who are doing agriculture, labour-intensive manufacturing, working through the development chain. That change in production has a very big impact on the global systems of production. But also there's a massive change in consumption. These populations, as they're moving through development, go from a very intensive, low nutrition diets into very high nutrition, high intake of beef, etc. This consumption change is really quite dramatic when you look at the scales involved. So we have this potential on the production side to see enormous shifts, and we've already seen them in the last decade, but on the consumption side to see equally impressive but very different structural shifts. We're going to have pressure on renewable resources, massive increases in demand. Development is a very resource-intensive exercise. But again, these countries tend to be very poor countries for some strange reasons, tend to save a lot. So they're going to be still a source of global savings, but they're also going to be big opportunities for investment. If one of the rosy pictures of the North Atlantic financial crisis has been that potentially capital which used to flow from the poor countries to the rich countries now has the opportunity to flow from the rich countries to the poor countries because we've discovered that the rich countries don't know actually how to allocate capital very well. And again, there's this development of these poor countries, emergence of China and India have the source potential for major environmental damages, but also enormous opportunities because we have an opportunity to intervene before these countries reach the stage of development that we have. Now, just to show you how quickly the world is changing, this is a chart showing you the share of energy consumption. And as you will understand, the US is by far the biggest energy consumer in the world, followed by China. But if you look at it not in terms of where the world is, but how is the world changing, this is a chart of the additional demand for energy between 2000 and 2006. Nearly 50% of the additional energy demand has come from one country, that's China. So that the changes that are going on are very big. This is a chart from a recent paper I did with Adam Cagliarini at the Reserve Bank, looking at prices of energy and prices of materials and what happens when China and India grow quickly. And you can see here, this is the actual data. You can see that between 2003 and 2007, we had a threefold increase in the price of energy, a doubling of the price of mining, and actually almost doubling in the price of food. So there's some very big changes going on as a result of China and India. One of the key questions is, will the world run out of resources? And my own view is there are short-term issues associated with the allocation of these resources, but it's unlikely that the world will actually run out. What really matters is how quickly does the supply side respond. Canadian tar sands become very, very cost-effective at about $50 a barrel. There's an enormous quantity of oil under Canada, bigger than Saudi Arabia. So the substitution to those sorts of substitutes is possible on the supply side. but also people will respond on the demand side. And so over time, we're likely not to run out of resources, but we could be talking a decade or two. And so in terms of the impact for Australia's terms of trade, it's unlikely that we're having a permanent terms of trade shock because of these responses, but it is likely we're having a very long-term terms of trade shock. One of the key questions that comes up is, what will be the environmental consequences of what's happening in the world if we're not pricing the environment properly? If we don't have a carbon price, if we don't have a price on degradation of the environment, what will happen when the world expands to the extent that we think it will? Another issue is demographic change, and I won't say much about that. I just wanted to show people a graph again. A lot of data, you probably can't see what's going on here. I just want to make 2 points off this graph. One is that these are the projections from, if you look at the from 1950 to 2005, the world is sort of growing at a fairly constant rate. From here on out, the UN is projecting all economies will slow down in their population growth. And that's a critical change in the world economy. So all economies' growth rates are falling. But what's more important is that if you look at the zero axis, there are a few countries whose populations are actually shrinking. Former Soviet Union, Japan, and even China by 2040, the population is expected to be shrinking. Now, the reason that's important is because there's some very important compositional effects. This graph shows you elderly dependency ratios. This is the number of elderly people over 65 relative to the working age population. You can see in this projection, by 2050 in Japan, there will be 10 working people for every 7 retired person. Now, that's a fairly substantial adjustment that has to be made. But that's not true just in Japan. In Europe, for example, there'll be, for every 10 working people, there'll be 5 retired people to support. And this demographic transition is happening particularly actually, unfortunately, in China, because in China the number is 10 working for every 4 elderly. And the question that is in the minds of policymakers in China is, will they get rich before they get old? Because their demographics are very, very problematic. And I'll finish off talking about climate change. And again, this is a question that I spend most of my working time on, and there's a critical point in the terms of institutional design and policy design. Is it better to sit around a large table and design a global policy that we all go away and implement, or is it better to have each country implementing a credible, clear, transparent set of policies given their own national circumstances and coordinate that over time, building up to a global system? Now, I have a very strong view on that the former will not happen, and that what's going on at Copenhagen now is what happened at Kyoto in 2007, which will be lots of political pronouncement, lots of goodwill, lots of hope, but no firm policies. And emissions today are well in excess of any forecast of emissions made in 1997 of what emissions would be today. So for all the debate about Kyoto being a success, we are 4 or 5 standard errors away from what we thought emissions would be, even without a policy response. In terms of the framework, I think the problem with Copenhagen is that the negotiators are focusing on the wrong set of questions. What they're thinking about is equality of targets. But we know what countries want, and this came out of the Bali meetings, is they want equality of effort. Now, equality of effort is very different to equality of targets. If all countries have exactly the same target, the effort required to achieve that target will depend on your population structure, the resources available in your economy, the energy systems you have, whether you have a nuclear power industry, whether you have fossil fuels, coal, oil and gas laying around, whether you have access to renewables. So the effort is not embodied in a target, the effort is embodied in what does it cost. And so therefore, really what we need to do is balance the need for this global concentration target, which is not an annual emission target, which is what's being negotiated. It's a concentration target of emissions over a long period of time, the target of which, by the way, is very uncertain. Is it 350? Is it 450? Is it 250? Is it 650? The science on that is very uncertain. So we're dealing again with a very uncertain world, but we have to balance the costs against the environmental goals. What are the challenges facing Australia? And I'll finish up here, Chairman. Firstly, climate change. Should Australia adopt the CPRS, or is there a better way? And anyone who's heard me speak before will know my answer to that. And then how do we deal with the large relative price changes that we inevitably are going to see coming out of China and India? So in terms of climate change, again, let's just remember what we should be doing. We should be designing a system that focuses on risk management. How do we get industries to finance investments to reduce greenhouse gas emissions? This is not the government that's going to pay for this. It's too small, globally and nationally. It's the private sector, so we have to encourage the investments. We need long-term price signals. We need long-term markets where risks can be managed. We don't want people to have no risk. We want people to try and take risks to develop technologies and then get a payoff and get to keep it if they're successful. We need an independent central bank of carbon to manage climate change and to pull it away from politics. And I've written extensively on that. The CPRS has many flaws, but these can be fixed. We need to preserve the balance sheets of households and firms by giving them the emission rights over a long period of time but have them evaporate over time. We need to announce a large deep cuts target and then smooth the costs by allowing short-term annual permits to hold the price at a given pre-announced level in the short term. We should divorce the climate policy from the fiscal accounts, because you'll end up with what we've seen in the last 2 weeks, where we see numbers dramatically change the politics of climate policy. And we should adopt a hybrid, but I won't say any more than that. Now, Australia, in the terms of trade boom, there is a big period of adjustment coming. I don't think this is permanent, but I think we're talking decades. How should we respond? One aspect of this is how do you do demand management policy when there's this big demand for one particular part of our economy's production? Can we use monetary policy to try and stabilise the economy when demand is surging so dramatically? I don't think so, but it may be the only tool we have left. What we do need is a way of dampening domestic demand and a way of hedging the risk that this boom will go away like it did last time and the time before and the time before that. How do you do it? One way may be a sovereign wealth fund where you invest all of that additional revenue coming from the resources boom offshore. The problem with that approach is that it's actually government controlled, and there are a lot of philosophical questions why you may actually want to allocate that additional revenue to individuals in individual retirement accounts and have them manage this, the national wealth rather than the government. So I'll finish up here by saying that there are many economic and political challenges facing Australia in the world in coming decades. The key here is that we have to devise strategies for risk management. We don't know what the world would look like in a decade or 2 or 3. We have some broad scenarios that I've painted for you here, but they could well be wrong. And we shouldn't just rely on our forecast being right. And there's been a tendency, particularly coming from parts of finance and treasury, that all we have to do is get it right next time. Well, we won't get it right next time. We won't get the greenhouse emission projections right in 2020. They will be different to what my model says and what Treasury says. The key is to make the institutional design changes now so that we channel private incentives appropriately. So this is a mix of the government and the role of the private sector. And the key here is in all of this analysis is to make sure that we're balancing the expected costs with the expected benefits of various types of policies rather than exploiting short-term political opportunism. And my website is available, sensiblepolicy.com. Thank you.
Warwick, Phil Lasker from the ABC. I was interested in your comment towards the end when you talked about domestic demand management, and you were saying that monetary policy may be the only option left to us in demand management. Why do you say that?
Well, I can't actually talk too much about monetary policy and demand management, but we've seen from the previous boom and bust that fiscal policy wasn't used very effectively to manage aggregate demand. We had tax cuts being given at a period where we thought that the terms of trade was going to keep rising. So people do argue, there is a philosophical view from the right that all we do is give all the revenue to the individuals in the economy and they'll make the right optimal decisions and you won't have a problem. The reality is that that's not the way the economy actually works. And there is a role for, I think, pulling some of those resources out of the economy in the hands of individuals in terms of how you manage it, but actually just to hand the money as tax cuts is just going to crank more aggregate demand into the economy than I would feel comfortable with.
The Australian dollar has appreciated 23% against the Chinese yuan over the last 12 months and 31% since March. You talk a lot about protectionism as a trade or a tariff issue. There's a lot of writing now about the yuan pegged to the US being an exchange rate protectionism, beggar thy neighbour policy under another name. Warwick, what do you think about the issue of exchange rates and how it's going to settle into the new economic order following the GFC?
Well, I won't talk about the Australian dollar, but I think the Chinese are actually realising that it's hurting them very much to be doing what they're doing in terms of what it means for domestic credit expansion. China would be clearly in their national interest to let their currency appreciate. Not necessarily float, but have it appreciating relative to the US dollar. There are Chinese special interests involved in doing that. The reason they're not doing it is partly to do with worry about the foreign reserve losses, several $1 trillion worth of exposure sitting in US government bonds. Once they do that, there's a concern in the US that capital will flow out of the US because they will flow back to China. There's all sorts of complex political issues associated with it. My view is that the more currencies are let to float, the better. And it's not just China, by the way. Most of the developing countries are actually holding on to a US dollar which is inevitably with large standard errors around it, inevitably going to be depreciating given the adjustment that's required on their external accounts. Now, in the New World Order, this is where the international institutional design is very important. And the International Monetary Fund was devised as one of the Bretton Woods institutions to manage imbalances and shifts of resources across national borders. There has to be a refocusing of the IMF. There has to be a change in the structure of the IMF in terms of the management. The developing countries have to have a much bigger say in the way the IMF runs. There is even a pretty good case to have a new global reserve currency, and it won't be an individual national currency, because if you look at every one of these national currencies, it's not clear which one could be the reserve. But we could revisit the old literature that Robert Triffin and others wrote about creating a basket world currency.